All right, so let's begin the show, and it's going to be insurance that we are going to talk about and various aspects of insurance. But then let's begin with an insurance cover for all the students studying abroad. If you are a parent and if you are planning to send your kid abroad for higher education, how should you be covering your kid with the right kind of insurance policy? And also, we will be focusing on policies related to cancer or other critical illnesses, all of this. And for that, I have Amjad Khan, Executive Director, Employee Benefit Practice, International Business, Anand Rathi Insurance Brokers. Amjad, good evening and welcome to the show. So we've been seeing a series of international studying insurance covers which companies are launching, especially for students. I would like to understand in terms of a health insurance policy that they might have in India also, how different would be this specific cover that covers you if at all you're going abroad for higher education?
Kavita, good evening and thank you for inviting me to your show. Yeah, coming back to insurance policies, health insurance policies covering Indian students studying abroad, we've got to understand that usually there were two kinds of products earlier. If you go back in the past pre-pandemic times, one was an insurance policy which covered their travel to those countries, and second was a health insurance cover which was required while the student was studying in that particular country. Now, what we see today is a lot of hybrid policies which combines both of these. But if I have to compare them to a normal group health policy, now group health policy in India will cover your inpatient hospitalization, whereas the group travel policy along with the health insurance benefit abroad will cover, obviously it will cover the inpatient hospitalization in case if it happens in that country. But apart from that, it also covers a lot of transit and travel risk, which is like a baggage risk or your document risk or any kind of hospitalization or accident which might happen for the student during those times. So that's how it's different. And from a price perspective, Kavita, it's very, very different because in India, the health insurance is far cheaper than what you might get in foreign countries. So there's a big differentiator which is on the table for parents whenever they have their child going abroad for studying. They got to look at it because the price could vary anything between 5 to 6 times of what they might incur if they had to buy the same policy abroad.
Plans that we are discussing over here are Tata AIG Student Travel Guard, Bajaj Allianz Student Elite Plan, Royal Sundaram Travel Secure Student Plan, and Care Health Student Explore Plus. What are the common benefits or features, if this is the plan that you have over and above your health insurance plan, which is specifically for your child who's studying abroad? What could be the distinguishing features in these plans then?
So, Kavita, to start off with, one thing we got to decide the geography because your premiums will depend on that. So, if your child is studying in US or Canada, his premium would be very different than a kid studying in the United Kingdom, right? So, geography decides the price. Along with geography, another important factor is what is the medical cover limit you choose for. So, on an average, 100,000, that is $1 lakh, is what must be chosen as the bare minimum adequacy cover for covering the health incidences which might happen in that particular country. But now, if we move from these two aspects, we look at the coverage in detail. As I said, in these policies, the differentiator is trip-related risk, which is like a trip cancellation or a delay or a missed connection. All those things are covered under the policy, especially under the trip-related risk which you have. Other things like baggage risks are also there, delay in baggage, loss of passport, all those things are also covered. And now the most important element is the health insurance which the child has in those countries. So any kind of inpatient hospitalization would be covered because of this policy. You also have additional coverage like dental treatment, personal accident, medical evacuation, emergency evacuation, even repatriation of mortal remains. These aspects are also covered under the medical policy. And apart from these basic core coverages, you also have certain extensions under the policy, like you can have a health checkup done, cancer screening done. You can also opt for a pre-existing disease ailment under this, which makes everything covered from day one. You also can add accidental death and dismemberment, study interruption due to any political risk or social unrest in that particular country. So that will cover the additional days with the child has invested in that particular country. So these are the further add-ons which are key whenever you buy a policy. But broadly, the first three risks, apart from your health insurance, would be your trip-related risk, your baggage risk, and obviously choosing the right sum insured based upon which country the student has gone to.
So also, Amjad, since it depends on the kind of geography you've decided for higher education, what could be an approximate premium amount, talking about places like UK and Australia, you know, where students usually prefer going, US?
Okay. So if I have to compare US and Canada, because that falls under a separate bracket altogether, the premiums could range from anywhere between 10,000 to 45,000 Indian rupees per mandated local health insurance, right? Which is very expensive. And as a consumer, you don't have a choice. You have to buy that. So in that scenarios, what we do is we recommend to buy a basic coverage in that particular country and then add on these top up and riders, which you mentioned, which gives you the comprehensive benefit and yet at a lower cost. So you can definitely add on these riders onto the main plan, which you have bought locally, if that country or that university demands for such kind of a mandate. But otherwise, these riders can very well be put onto a health insurance, overseas health insurance plan.
Amjad, what about the process of settlement, be it a rider or a comprehensive plan that you've bought? What will be the process of settlement? Also, because you're dealing with a different currency. So, what could be the technicalities that one might face?
So the process of settlement is pretty simple here. You have a toll-free number along with toll-free number is there given for under your policy terms and conditions. So whenever you call that toll-free number, you have a designated person who will be in charge of the entire incidents which has taken place. Now, the mandate that the insurance company wants is the moment there has to be a call registered with the insurance company within 48 hours of the incident, or probably 7 days of that incident via an email. So that's where the liability for the insurance company kicks off. In terms of settlement, the settlements will obviously happen in dollars since the student is abroad. And if you look at the medical part is a cashless part, right? So these are global networks of hospitals which come under different entities, like a Cigna as a very wide network globally. You have United Healthcare Group, you have Mayfair. So these are big network bodies across the world which have hospitals within the network. So except the medical, because medical is completely cashless. That simply means the student does not have to pay a single penny out of his pocket unless he has some conditions open in his policy. Otherwise, the baggage, the transit, all those risks are reimbursed in terms of dollars because that's how the policy is defined. So the payout would happen in dollars in those countries.
So just quickly, one last question on this topic. What should be your checklist before going for either a rider or a comprehensive plan for this particular purpose?
So you got to ensure a couple of things whenever we decide for a student overseas travel come a health insurance plan. One is we have to be very wary about the fact that what should be the sum insured limit. So as I said, $100,000, that is $1 lakh is the median which is recommended. But I would say if you are in US, Canada, your limit should be anywhere around $500,000. To simplify that, it would be $5 lakh what I'm talking about. And for any other non-US Canada country, it can be around between $100,000 to $300,000. So that is the adequacy level, seeing the cost of hospitalization and cost of healthcare in these countries. So that's one thing. And then trip-related costs and your baggage-related costs, these are the two things which you should definitely cover. While doing so, we should not forget the add-ons like personal accident, medical evacuation, emergency evacuation, repatriation of mortal remains, financial emergency, daily allowance. So these are very smaller aspects when you decide a policy, but in case the incident happens, these play a very vital role in terms of helping you support financially in that particular country.
All right, so this was all about buying a health insurance plans for students studying abroad, but then let's move on to a different topic or another topic of insurance, which is having a cancer policy. Amjad, the big question over here is, do one really needs to have a separate cancer protection plan, cancer protection policy, or just having a critical illness cover on your basic health insurance plan could be enough?
So, Kavita, critical illness is a great rider to have onto your existing health insurance plan. But what we are seeing in the last 10 years, if you look at the statistics, the hospital data, the number of cancer cases are growing, right? So that is on a very high rise. And the cost of cancer, it's not a one-time hospitalization, it's a recurring cost. And that's where the cost of hospitalization under a cancer care, you cannot predict at what end it will fall. So that's why even a 20 lakhs might be insufficient. And that's why you see insurance companies coming up with exclusive cancer health insurance plans, which has a limit of almost 1 crore, 2 crore, even 3 crores as well. So from that perspective, I think as per the changes happening in our country and the incidence rate on cancer rising, people should look at an independent cancer health insurance plan as they go ahead.
All right. So let's dive deep in specific cancer insurance health policies. So we have a couple of them, the names given by you: Bajaj Allianz, Healthcard, Platinum, HDFC, Ergo, Optima, Secure, Tata AIG, Global Combo, and Manipal Cigna Prime Advantage. So these are specific cancer insurance policies, and these are to be taken if you are diagnosed with cancer. Can these policies be taken?
No. So firstly, an insurance company will not allow you a policy if you're already diagnosed with cancer, because one thing very important to understand is these policies are high, it's less frequency, but high intensity in terms of impact of claims, right? And that's where the sum insureds could range from 1 crore to 3 crore. So anybody who is diagnosed with cancer surely cannot be a part of this policy. And secondly, if you have bought a cancer insurance policy,
be it any stage and be it any kind of cancer, if it's already diagnosed, you will not get it.
You'll not get it. That's
even
right.
After a certain amount of waiting period, because in certain type of cancers it might just not relapse. So even then you will not get it.
So if you are cancer free and a doctor certifies that, then you can be issued a policy. But whenever you get a policy issued,
but that has to be under a very strong underwriting. That has to come with a very strong underwriting then.
That's right.
Okay. Yeah, please carry on. Okay.
Yes, obviously a very strong underwriting, but as I was saying about the waiting periods, even if you buy a new cancer insurance plan, there is a waiting period of 3 years. Depends from company to company. Some companies give you for 2 years. But in case if you're diagnosed with cancer before the 3 years waiting period, that claim would not be admissible as well. So it's always better to buy at a younger age, probably 30, 35 should be the right age to get an independent cancer insurance plan.
Can someone who's been diagnosed with cancer come under a family floater health insurance? Because we get a lot of these kind of questions.
So currently, Kavita, these plans are independent and individual policies. But as I said, as the incidence rate changes in the country, we will eventually see that you'll have a family being covered in the cancer care program. But if as of today, it's an individual policy which you can take.
So Amjad, the question was, in a general family floater health insurance policy, can a person who's diagnosed with cancer get the coverage?
So if you've taken the critical illness rider, yes.
Okay. Even after being diagnosed.
Sorry, Kavita, I missed you.
Even after being diagnosed.
Yes.
Okay, then you can add a critical illness rider to your existing family floater and not even an individual health policy.
Yes.
Okay.
Small correction. I think I didn't hear you properly, but you said even after diagnosed. So no,
yeah.
if you are diagnosed, then you cannot add a critical illness cover.
Okay. All right. So that's an important clarification. Okay, let's come down to these specific cancer insurance policies. So the sum assured is usually in crores. Obviously, that's needed. So what's the kind of premium that you might have to pay, or it depends on the kind of cancer we are dealing with?
So it's not about the cancer you're dealing with, Kavita, because it covers broadly most of the cancers, except a few. I can name them as we go ahead. But your premiums would range from anywhere between 20,000 to 40,000, depending on what are the kinds of add-ons you've taken, what is your sum insured, and which insurance company. So that's the approximate range of the premiums.
What kind of cancers are not covered under the cancer insurance policies also?
So under these policies, skin cancer is obviously not covered, and any cancer which arises out of sexually transmitted disease or exposure to nuclear or radiation kind of an atmosphere, or any cancer which is congenital or maybe a pre-existing condition, these would be denied under the policy.
So Amjad, what kind of treatments and what is the coverage breakup as per these specific policies?
So, Kavita, these policies will cover all your costs, which includes the hospital stay, radiation, chemotherapy, surgery, medications, prosthetics, and any other associated treatment around this. In fact, some of the policies extend an add-on where you can probably add an Ayush benefit, an alternate line of treatment, if that is admissible under the policy. So these add-ons can also be taken. There are some insurance policies which give you a worldwide cover. So if you want to get your cancer treated globally, you can opt for that as well.
Amjad, can senior citizens take this policy?
Senior citizens can take this policy unless if they have been cancer free, but as you mentioned previously, if they've been diagnosed, nobody can take it. Doesn't age does not matter.
Yeah.
But yes, senior citizen can very well take this policy with a waiting period of 3 years.
All right. So looking at the entire insurance plan, that one needs to have a life insurance, a health insurance, and is a critical illness rider must, or a cancer insurance plan specifically must?
So I think the least we can do is to ensure that we have a critical illness rider.
Sure.
But if you have an independent cancer insurance, I would say it's a very proactive approach to look at healthcare.
All right, so that's the take coming in. Thank you so much, Amjad, for being on the show and helping our viewers with all these very crucial topics on insurance, which is a very critical aspect of financial planning also. Thank you so much for being on the show. We'll take a quick break, but then post that, let's understand investor profiles and investor personalities based on which you get to decide your investment strategy. After this break with Nirav Karkera. Watching The Money Show with me, Kavita Thaplial, and let's talk about investor profiles or investor personality, which is a very crucial aspect of your investment strategy. So I have Nirav Karkera, Head of Research Wisdom, on board to explain all of this. Nirav, good evening and welcome to the show. A very important practice which an investor, he himself or herself should be doing even before approaching anyone or even a professional, to get a help for their financial planning or their investment portfolio. This is a very important part of your homework that you as an investor should be aware of. And when we talk about investor profile personalities, we are usually talking about the risk profile that they carry, so that it gets easier for them to understand the kind of investment options that are available for them, or they match, or the ones that match with their profile. So what kind of investor profiles are we talking about over here? A person who just cannot take risk, who's risk averse, a person who is very aggressive in nature when it comes to risk. Is it all related to risk?
Yeah, so there are a variety of ways in which one could classify a risk profile, or rather an investor profile. But yes, whenever we are talking about investing, risk becomes a part and parcel of this entire conversation, albeit a very integral one. So a lot of classification rests on the premise of the risk-taking ability and willingness of an investor. So generally, in common parlance, when we talk about an investor's risk, we refer to it as a risk profile. But very seldom does a person realize that a risk profile is made of two important components. That is an individual's risk-taking ability and the risk-taking willingness. A blended assessment of these two vectors gives a clear picture of what is the personality type of an investor in terms of risk. Obviously, there are various different ways in which investors could be classified based on the preferences, the restrictions. So, there could be a classification basis. What are the kind of preferred instruments or preferred asset classes of an investor? But most of this becomes inconsequential once we start having conversations around the risk aspect of life.
So when we talk about these profiles, do we have a suitable investment option for all of these risk profiles?
Yes, absolutely. Absolutely. So, there are three primary risk profiles of an individual. Like you rightly said, it starts with risk averse investors towards the far left. At the center, we have risk neutral investors, and on the aggressive side we would have risk seeking investors. So for different types of investors, there are different kinds of products that are well suited and best suited to their persona or investment profile per se, or the risk profile per se. So for a very risk averse investor who basically does not want to take on too much risk and is trying to achieve a lot of predictability, sustainability, and a lot of visibility in their returns, there are options in terms of more fixed income oriented products. We could talk about small savings schemes. We could talk about traditional bank fixed deposits. We could talk about certain select mutual fund categories like debt mutual funds, these slightly conservative hybrid mutual funds. So these are best suited to conservative investors. We talk about risk neutral investors who are basically the people who simply want to be compensated for the amount of risk that they're taking. They have nothing in favor of or against risk. All that they're seeking is to compensate, to achieve, due compensation for the level of risk that they're taking. So for such investors, a brilliant option is mutual funds, because mutual funds offer a variety of categories and a variety of investment plays. So within mutual funds itself, such investors typically tend to gravitate towards more flexible mandates, more optimal investing strategies, risk optimal investing strategies like flexi cap funds, multi cap funds. We talk about balance advantage funds in the hybrid category. So in these broad mandate, flexible mandate mutual funds are best suited to risk neutral investors, because they manage to participate in the upside while effectively managing against the downside. As we move towards the far end and we talk about risk seeking investors, these are the investors who are typically on the lookout for risk. They want risk, they have an appetite for risk. Their North Star metric is returns. They want to achieve returns no matter what, and they don't mind if it comes at the cost of taking incremental risk. So such investors move towards products that tend to have very high volatility. And obviously, it goes without saying that they gravitate towards capital market linked products and towards equity as an asset class. So such investors within mutual funds, they would move towards highly volatile mutual fund categories. For instance, it could include your sectoral funds, your thematic funds. It could include mid and small cap funds, wherein the returns are slightly lumpy. It comes in cycles. The volatility is steep, but when it comes, it really showers. It really rains when the returns finally do come in. So these categories do really well for such investors, and you would notice that such investors also tend to build up direct equity portfolios. They towards a certain extent, they would also include derivatives, FNOs, as a part of their portfolio and the regular portfolio management exercise. There are thematic PMS and AIF schemes, which are generally reserved for those with ability to invest up to higher ticket sizes, because the minimum ticket sizes are really high in PMS funds and alternate investment funds. But the ones having an aggressive risk appetite, or who are risk seeking by nature, tend to invest in such thematic products wherein the risk is really high, but the return potential is probably outsized and far greater than that.
So talking about these three profiles, how can an investor from time to time change all these profiles within their investment journey?
So it is a journey, right? The most important keyword that you spoke about is a journey. At some point in life, most of us go through each of these phases as an investor. At certain point in life, we would better associate ourselves as risk averse or risk neutral, or risk seeking at different points in time. And all of this has to do with the background that we have in terms of our financial, economic, social background, our personal preferences, our behavioral preferences, our behavioral biases, and our objectives, our goals, and our aspirations. A culmination of the past, present, and the future results in the personality type that we have as an investor today. So the kind of risk profile that we have is largely a bifactor of these three things, and it also determines our investing style. So at different life stages, one would typically categorize a person having a very high risk-taking ability. And risk-taking ability is defined by, very, as a crude example, as an individual who has very limited responsibilities, who has income way higher than the expenses, who has all the basic needs met, and is living a comfortable lifestyle, and yet left with a lot of money to invest. This could typically indicate a high ability to take on risk. At the same time, a high willingness to take risk has a lot to do from a personal background standpoint. Whereas if the person's background permits him to be a risk-taking person, if he belongs to a conservative background or an aggressive background, if he personally is a risk taker, if he has the appetite to take on more risk for more returns. So a combination of these two things, like I pointed out at the start, a combination of such ability and willingness really positions an shapes how a person acts while finally investing.
All right, so crucial points about knowing your investor personality and a very crucial step in your entire journey of investment. Thank you so much, Neera, for being on the show and helping our viewers with that. Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and let's talk about ESG funds. We all know that every AMC is supposed to have one ESG funds, but then SEBI has now permitted AMCs to have thematic ESG funds also. Now, what does this mean for you, to you as an investor, and how should you be looking at ESG funds and thematic ESG funds as an investment option? I have Tarun Bhirani, founder and CEO, TBNG Capital Advisors, with me to elaborate more on this. Tarun, good evening and welcome to the show. So ESG category, which is still picking up, and we've discussed this a lot of times on the show as well, where the future definitely is towards this particular initiative, which is good for the environment and healthy for your portfolio also. But then talking about it now and the way SEBI is looking at it, having categories introduced under ESG sounds very interesting. But as far as the nitty-gritty goes and types of innovations that a fund house can do with the kind of theme that's been slotted out by SEBI, how investor friendly do you think this entire category now looks like?
Right. So, good evening, Kavita. So, ESG funds signify an innovative investment approach, which basically centers around these three important factors, right? Environmental, social, and governance. And all these thematic funds have been positioned around them. So these thematic mutual funds are assessed not only on their traditional matrix of historical performance and business model, but based on their environmental, social, and governance factors. And based on that, 80% of the assets need to be ESG compliant securities, and balance 20% are refrained from securities in stark contrast to the ESG philosophy. So what are we talking about as a ESG thematic fund is basically it opens the door to various strategy, and there are many 5-6 different unique strategies which can be looked at. One is like a exclusion. By exclusion, I means avoiding specific sectors or practices which doesn't comply with this. Then integration. Integration includes combining financial and ESG factors. Best in class and positive screening, it looks at strategy or companies which have a approval or the positive screened under this category. Impact investing, investing which is making a lot of impact on a lot of environmental, social, and governance things, and as well as sustainable objectives, so wherein how sustainability can be capitalized, a lot of ESG trends can be capitalized. So all these, and transition. So these are 6-7 different themes. I know it sounds a little complex, but all these funds will be positioned now with the advent of ESG funds. You will see all these new categories to develop around that.
Right. So now talking about the different themes, if in a nutshell, if you could explain what are these themes and how can investors, basically looking at their portfolio and looking at their financial goals, because that is how you need to strategize your investment portfolio, accommodate these themes and tie it up to a specific goal if at all possible.
Yeah, so basically, I know that financial goal planning and everything continues to be same. There is nothing different there, right? I think what are your long-term goals, core and satellite approach, ensuring what is your risk profile, suitability, all those points continue to be there. If I have to talk about suitability, from a suitability point of view, this is for an investor who is ready to dive into a new category, who has a risk appetite, and who has a larger time frame, because this is something as a movement which is happening across the globe, right? ESG as a movement. So definitely India is going to catch up in this movement. So my suggestion is investors who have a long-term outlook towards investing can definitely look at ESG as a theme, and whatever is your personal belief system. I think ESG definitely helps you connect with your personal belief system around environment, society as well as governance. So all those can be actually looked into, and it's actually a lot of impact investing can happen here. But talking about, can the existing funds cannot buy companies which are ESG compliant? Answer is yes. They can definitely keep on buying these companies. So investors who want to wait and watch, see how these funds take off, and then want to participate, maybe want to see 1 2 3 years of performance, and then maybe they can enter into this category.
Talking about investing in these funds, you think it is time to initiate this particular step now, or one can really wait and see how this entire category develops, and this is not something that you really need as a part of your core portfolio?
Yes, definitely. I don't think this is part of the core portfolio. Core portfolio is already is the one which is helping you achieve your most important financial goals. This is one of the thematic category which comes under the satellite approach. So my suggestion would be, if you want to wait out and see 1 2 3 years how this category actually develops, and actually your existing funds can actually buy into companies which are ESG compliant. So I don't see a problem in that part.
All right, Tarun Virani, thank you so much for being on the show and helping our viewers with all about ESG funds today. Thank you. We move on, and let's get your financial portfolio queries answered, because the very purpose of having an investment portfolio is to actually figure out a financial goal for yourself and do an investment according to which is aligned to that particular financial goal, being buying your first house, or maybe even strategizing your retirement, your first car, or maybe even a phone that you want to buy. Anything and everything can be planned, and for that you need an investment strategy. For this, I have Shweta Jain from Investography today, and you can actually send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. Shweta, good evening and welcome to the show. I have first question from Bhaskar. He's written this question from Hyderabad, I guess. Yeah. And he says that he's a retired person and he has 20 lakhs with him right now. He wants to invest for maybe 2 to 3 months, a very short period. And he wants you to advise the right investment option for this.
Hi, Kavita. Thank you for having me on the show. So for 2 to 3 months, I would recommend a short-term bond fund for Mr. Bhaskar, a couple of them. Bandhan Short-Term Bond Fund is a good fund that he can do. DSP Low Duration Fund is something else that he can do. And he can add on if he wants a third fund to the mix, because it's a good thing to have 2 to 3 funds. He can also do Kotak Bond Fund short-term.
I have Bhaskar online with me. Bhaskar, hi, good evening. Thank you so much for sending us your query. And Shweta just recommended a few investment avenues where you can park your money, because the time period is only 2 to 3 months. So we cannot recommend you an equity strategy. It has to be a debt-oriented strategy where you don't have any risk per se related to that. Anything else you want to ask Shweta?
Madam, actually, I am a retired person. Yes, sure. I have the amount with me. Mm-hmm. So I have to pay it after 2 months. So
Got it. So Shweta just recommended you. Right. So she just recommended you a short-term bond fund and also a liquid fund. If in case you have missed the names, you can maybe watch the show again on our YouTube and note the fund's names down from there. We move on, and do I have Mr. Rajesh Kannan? Okay, I don't have him on the phone line, but Shweta, let's take his question. He has a surplus of 10 lakhs and he wants to understand where he can park this money. Now, I don't have a lot of clarity, but then he's clear about having a liquid or maybe an ultra short and arbitrage as an option of investment. So, yeah, we don't know his risk profile, but what would be your recommendation?
So ideally, when I don't know complete details, I err on the side of caution.
Sure.
So an ultra short bond fund, so the funds could be Kotak Low Duration Fund, could be Kotak short-term bond fund or a Bandhan short-term bond fund. These are funds that are good credit quality, are good short-term funds to have. If he would like to do arbitrage funds, I would see a bare minimum of at least 4 to 5 months, because you do want to see some strategies play out in arbitrage funds. So 4 to 6 months is a great time for you to have. If you're giving arbitrage funds a chance, then he could look at a Mirae arbitrage fund. He could look at Invesco arbitrage fund. So he can see some of these arbitrage funds if his time horizon is more than 4 months.
All right, if the time horizon is more than 4 months, maybe you can look at these investment options. And over here, the purpose is just to keep your invested or your capital amount safe, right? We are not talking about earning anything on, but that's not the priority is what I'm trying to ask you.
Yeah.
Okay. All right, we move on and we'll take the next question from Naman, and this question is also via an email. So the total mutual fund portfolio that he has is of 1.14 crores and he's invested 35 lakhs through direct plans, monthly SIP of 50,000 per month going on. And we don't have the name of these funds, but he wants to understand if the market is at records high and if the market corrects from here now, will he get an average NAV if he's invested in direct plans through SIP? Can he book profits on his regular plans?
So I think Naman has a great question, because a
Right.
lot of investors do struggle with this combination of regular and direct, because some schemes may be regular, some schemes may be direct, and they may want to switch everything to a direct portfolio. So yes, when you're looking at market highs, you can exit and enter, but the downside is that you're going to pay a lot of tax, but you're not really using those profits, you're just investing that back. So think about it smartly. Don't time the market. The other thing that happens is people are then looking at timing the market and saying, okay, now I'm exited at highs, so if I've exited, how can I enter at these highs again, right? So unless they're doing an STP in the next 3-4 months and starting off immediately, I don't think it's a great idea for you to book profits now and then try and time the market. I would actually advise you that you stagger these exits from your regular mutual funds, financial year wise, to see how much you can take advantage of the capital gains, because I'm assuming some are debt and some are equity. So when 3 years complete for debt, for example, and when equity crosses a year and you have 1 lakh gain that you can take advantage of at least. So I would rather take that position and make sure that you're not paying any exit loads in these, if you build these over time especially. So make sure you're taking care of a few of these factors and then moving. I don't think you need to be in a rush to realign your portfolio just because markets are at the highs, because you're anyway going to invest in equity again.
So that's the answer for Naman. We move on and we'll take Ashish's question. He says he's a retirement government officer and he wants to invest 2,000 rupees per month for his pension. He's 67 years old and he wants to understand the kind of funds you might want to recommend. We don't have him on the phone line, otherwise I wanted to understand how, what would be the purpose of this investment. Anyways, the kind of information we have is very limited, Shweta. So what would you recommend?
So I think this is his pension money, which is excess. So he may want to first set aside some extra sort of money in the liquid fund or short-term bond fund even, so that if there's an emergency that can be used for that. If he does have a surplus fund which can be used for emergency, at least a year's expenses, I would say. If he does have that kind of money set aside, which is accessible, which is liquid, then I would say that he could look at a balanced advantage fund. I don't want to recommend equities because he's 67. I don't know if he has previous equity exposure. I'm assuming not. Then if in that case, I really don't want to give him stress. So a balanced advantage is something that I think I can recommend to him for at least if he has a horizon of 3 to 5 years and is looking to grow. And I think 1 year, if he invests, he can see how it's going and then sort of see if that suits him. So like a ICICI balanced advantage or if HDFC balanced advantage is something that I would recommend to him. So one, not both, just one of them.
Apart from that, any other completely debt-oriented category if he might want to invest in?
I would say then he could look at short-term bond funds. I don't want him to do too much long-term debt at the moment. So I would say then look at a Bandhan short-term bond fund or Kotak short-term bond fund, depending on which fund houses he prefers. If he does, then one of these could be somewhere where he can start off.
Question from Manoj. Which hybrid fund is good? Moderate risk one or the one where you get... okay, so the criteria is moderate risk and high returns, and he wants a specific hybrid category for this.
Okay, so risk and return do go hand in hand. So if moderate risk is something that you're looking for, I think you should look at moderate returns. I think expectation management is key here, because otherwise you're always going to be unhappy with the scheme, and you will want to keep switching sooner rather than later. So I would say something like a Kotak hybrid fund is something that he can start looking at. If he's looking at a higher side of equity, if he still wants higher risk, not moderate risk, then he could look at a balanced advantage fund, like an ICICI balanced advantage fund. But he has to be aware that the risk is higher there, because he is emphasizing on returns. I don't want to recommend hybrid funds which have lower equity in them, because then he might not be happy with the returns. So I think these schemes, whether it's a Kotak hybrid fund or a ICICI balanced advantage fund, these are schemes that he can look at and maybe dip his feet into it first. Maybe invest a little bit and see how it is and how he likes the experience. And then 6 months later, a year later is when he can increase his investments.
All right, that will be all for today. Thank you so much, Shweta, for being on the show and helping our viewers with their financial portfolio queries. And time to say goodbye on the Money Show, but I'm going to leave you with our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. Thank you so much for watching. Goodbye.